Good evening, everyone, and welcome to TradeStation. My name is Michael Burke. I'm Vice President of Client Training and Education here at TradeStation, and I want to welcome you to our Technical Analysis series. Today, you'll be joining Larry Williams in the last installment of his three-part Technical Analysis series, and we'll get started with Larry very shortly. If you missed any of the first two parts of this series, they are archived on our site, and I'll be pushing the link to those webinars into the chat very shortly. And this event will also be archived and uploaded to our site as well very shortly, probably within a couple of days. Also, I want to invite all of you to a very special event next week. Larry will be talking about his trading strategies. And so that will be a very special event that you can register for here. I'm going to push that registration into the chart now, and you'll get a chance to see some of the strategies that Larry trades and some of the work that he's done in the area of strategy development. So you don't want to miss that event, and there is the link that will allow you to register for that event. That's on the 28th next week at 4:30. Here is the link for the on-demand webcast where you can find Larry's first two events, and as well as this event once we archive it. So it'll be up within a couple of days. We have a great turnout today. We've got people on from all over Europe, all over Australia, Asia, South America. So wherever you are, I know that it's late in some places. Other places it's very early in the morning. So we really appreciate you taking the time to spend this time with TradeStation and with Larry Williams. So let's get started. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructor are for demonstration purposes and are not recommendations. Active trading is not suitable for everyone. Please make sure that you read the disclosure information on the TradeStation website and in the disclosure document that I'm passing into the chat now. So thank you again for joining us. Lots of great events here at TradeStation, so definitely take a look at our calendar and sign up for those events that are of greatest interest to you. We have ongoing market commentary events. We have our market commentary blog. All of these are available here in the documents window. You can kind of look through that documents folder in the bottom right, and there's links to everything in that documents folder. So without further ado, let's pass it back to Larry Williams. Larry, thank you for joining us for this last installment, and we really appreciate you spending this time with us. So Larry, it's all yours.
Well, Mike, thanks very much for having me here today. It's always an honor to be here, and especially to see names and people I recognize from literally all over the world. I mean, my gosh, what a privilege it is for me to be here. As we progress, if you have any questions at any time, feel free to pop right in and ask those questions. Don't wait till the end. You can ask any questions about anything you want to. Also, there may be a little background noise today. I'm in Red Lodge, Montana, in the high mountain country, and there's a large forest fire here, and helicopters have been flying over all day long, dumping water and chemicals on the fire retardant. So if you see or hear rather a large background whop, 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 it's not your internet connection. It's the fires in August in Montana. So this is the third part of a webinar series. Some of you may not have been on the other two parts. The first part, we looked at the past of the history of technical analysis and trading ideas and strategies. And then we looked at trading tools, the general ideas of what's out there and approaches. And so we tried to cover all those, whether it was Fibonacci or volatility breakouts or moving averages, to get a good idea of what's out there, what's gone in front of us. And I see, Mike, a couple of people saying they can't hear. Is that a problem? Oh, sound is great. Thanks for letting me know that. Okay, good. Okay, yep, fine. Thank you for that. And so what I want to do in this presentation today is get really specific with you. So we're going to talk about specific ideas. Hopefully, these are ideas you haven't considered before, and will implement your own trading strategies and ideas. So with that, we're going to start. And Mike, I need somebody to, oh, here's how I control the slide. So there are really only two ways of trading, discretionary or systematic. You really get down to it. That's it. You're either going to decide, hey, I want to buy or sell because you're angry at your wife, or because you have a mechanical system that says buy today, it flashes an arrow on the screen. Now, of course, there's a wide variety of ways in both discretionary or systematic, but it really gets down to those two ways. And I want to kind of look at both those two ways. This is why we like systems. That old Pogo cartoon, we have met the enemy, and he is us. Many people realize that they do not have the emotional capability to trade, or afraid of themselves of trading, of not doing the right thing. So they default and say, let's let a system do it. Let's let a mechanized strategy do it. So that's their way of trading. And it may be your way of trading. We're going to look at systems a little bit today and see how they've done. Try to set the stage here of what we can expect and not expect from a mechanical approach to the market. And then I'm going to show you things that we can look for that could be added to a mechanical approach or could be used in discretionary trading for us. Okay? But that is why we like systems. We're afraid of ourselves. We don't have confidence. There are other reasons. We know the expected results, why we would use the system. If you program the system, it tells you that your risk reward is going to be this and such, and your average profit is so and so. So we feel comfortable. Again, it gives us confidence. I think a real reason why people use systems is we're lazy. Say, you know what, it's hard work to trade, so I just buy a system or rent a system and just let the system trade for me. And also a big reason is we can't follow it during the day. A lot of people have jobs, and they can't follow every tick. So they have to either find a system that does all that for them or become end of the day traders to have any type of a semblance of a real life. The other nice thing about systems is you can arrive at money management values, and this may be the most critical of all of them, and that is you know what your risk reward factors are. They may or may not be that in the future, but you have a ballpark idea. Because of that, you can accommodate a money management strategy. Whereas if you're a non-systematic, you're a discretionary trader, you probably need to have a year or two of your own trading activity, your own trading results, before you really can start to hone in on some type of a money management approach that's based on your particular trading strategy. So that's a big reason I think why people like a firm system. Well, how good can systems be? Well, here's the bottom line of systems. Most systems lose. Most systems have large drawdowns, and most systems run hot and cold. In fact, in over half a century of being in the markets, I've never seen a system that always makes money. They all run hot and cold all the time. And invariably, when somebody is looking for a system, they're looking for a system that's been really hot. So, oh, it's been really working. So they get aboard the system. And systems that haven't been working, they're afraid will continue not to work. So people tend to chase the hottest dog in town, and that's the one that's probably most likely to get run over by a truck or a car. So you have to have kind of a balance, I think, of finding a system that has a long-term performance and ideally is recently has not been performing real well. It really bothers me. I trade mechanical systems, several of them at TradeStation, and I like to start trading the system after it's undergone a little bit of being beat up, slapped around the ears a bit, because in theory, if the system is going to hold up, and I suspect it will, then we're going to have that return to the means and it will start to click in again. So that's the big thing to remember about systems. Most of them actually do lose, and they're rather successful at that. There are several sites that have a myriad of systems you can rent, buy, sell, whatever. And if you look at those sites, some of them are partners with TradeStation. I think Striker is. Um, and you look at the tremendous amount of mechanical systems that have been traded real time, real money over the years. Most all of them no longer trade because they are not successful. There's only a handful of them that are left. Well, that tells us that this system trading stuff is not easy. To have a mechanical trading system that consistently makes money is very difficult. So I would admonish you when it comes to systems that there are a couple of things we need to look for. First, you need to identify why the system works. There should be some rationale. It may be a long-term trend following system, such as Aberration was a few years back, or the turtle trading system, or Dick Dodge's channel breakouts. Or is it a short-term swing trading system where it's trying to capture short-term, maybe even day trades in the market? Or finally, one I like, pattern recognition. I think all three of these have value and can be used, but you need to find one that not only fits your temperament that you can implement, but also has the risk reward ratios and the equity drops and rallies that you can live with as well. And you can't mix your metaphors here. You can't be a day trader and also following a long-term system, because your long-term system is bullish and your short-term day trading is bearish, and you'll start to get pretty rattled. So if you're going to have systems, in my approach, what I do, because I do discretionary trading, quite a bit of it, my mechanical systems are actually in a cloud computer where I can't touch them, or I could, but it'd be very hard for me. So they just run on their own. I don't know what they're doing half the time. I look at them about once a month to see how they're doing, but I put them where I can't bother them. Otherwise, I start to disturb them. And that's been a really great thing for me to do. So you need to know why this system should work. Now, this is a critical point about markets. I don't have a PowerPoint slide for it here, but all markets, it doesn't matter if it's a stock or a commodity or Forex, they're all traded by, they're all manipulated by, they're all moved by people. So what works in most markets works in all markets. What works in one market works in all markets, because markets are emotional and markets are driven by events. So how the markets play out over short-term swings is just the emotions of the day. And there's lessons we can learn, and those things repeat. Yet, there's a difference between the way gold trades and, say, hogs trade. Hogs have an 18-month reproduction cycle. Animals born, 18 months later it's killed. There's a different cycle in that market than there is in the euro currency market, where primarily we're looking at 90-day implements that are part of the commercial transaction, or maybe in the stock market, where earnings are reported once a quarter. So that has a massive influence on stock prices, whereas quarterly earnings really don't mean much to the price of gold, or certainly nothing to the price of soybeans. So there are intrinsic timing factors of each business, not market now. I'm making the point of a business here that we can then apply to the individual markets. I see a couple of questions have come in, so I will do systems stop working because of fundamental market changes or too many people following? I never think that there's too many people following the markets, following the system. That's a common thing. People say, well, the system stopped because too many people were following. I have yet to see a system that gets that large of a following. I think people stop following systems because the system runs into a drawdown and they stop, and then the system starts working again, or the system was over optimized in the beginning and it's just a bad system, and the system falls apart because it wasn't created correctly to begin with. Or it could be a market change. Good case in point. We went from the pit session market to electronic day trading market. And had a lot of systems that did really well, taking advantage of gaps in the day trading markets when we had days instead of electronics. Those don't work anymore now. It all changed. So you have to be adapt for things. I don't trust systems. Will I miss much? I don't know if you mean about later on in what I'm having to say. Yeah, you will, because I'm going to show a lot of short-term trading strategies you can use as a discretionary trader. So that's a general overview of systems. So let's try to get a little bit more specific. Pattern recognition, I touched on this. And what you don't know can really hurt you. So I'm going to talk about some patterns today that you can put into your systems, or you could use as a discretionary trader. I'd ask this question: what do you know about inside and outside days? You know what they are, right? An inside day is a day whose range is within inside yesterday's range. And an outside day is just the opposite. A day that has a higher high and lower low than the prior day. That's an outside day. Do you really know about these days? You really know what they mean? Let me show you some hard data on this. Inside days in the S&P E-mini, I went back to, I think this is 2002. There were 1,354 days in my sample, 1,300 in bonds, and didn't go back quite as far in gold, 1,168 days, total trading days. Outside days were 337 days, and inside days in E-minis were 146. In bonds, we had 260 outside days and a fewer number of inside days. And in gold, we had 191 outside days and a fewer number of inside days. So, first of all, we have more outside days than we have inside days. Secondly, and this is the big point, 1/3 of all days are inside or outside bars. So if you are trading and you have a system or a strategy or patterns, and you're not making a differentiation between inside days and outside days, 1/3 of the time, that's a huge number. 1/3 of the time, how would I say it? You're not playing with a full deck of cards. So you need to really understand inside days and outside days, and there are only a couple of other types of days we can have. We can have downrange days, down close days, uprange up close days, or downrange days with a higher close, or uprange days with a lower close. That's it. There's only a finite number of patterns that any day can occur in. So an outside day, again, is a day that has a higher high than the prior day and a lower low than the prior day. For a question for beginners, better position trading or swing trading, the answer is what fits your personality best, what fits your time zone. Some of you are 3 in the morning, some of you are 11 o'clock at night. What fits you? Are you a nervous Nelly? Then you're probably going to start day trading. Do you have some sense and you want to try to make some serious money? Probably swing trading. So you really have to find a trading strategy that fits you. There's no one straight trading strategy. Oh, this is the one to use again. Because it has to be something that you can do. If you can't be a day trader, incidentally, by the way, I think that's the most difficult way of making money. But you have to find a strategy that fits your temperament. That's the critical point. Okay, so inside days. My point is not all days are the same. These days need to be studied. Are you in the dark 1 out of 3 days? And that's really important. Oh, there's a great question that's come in. Is there a higher percentage of winning traders at positions in swing versus day trade? Pete, what I'd like to tell you is forget about accuracy and percentage of winning trades. That is one of the most deceptive and misleading things you can get. Always people say, how accurate are your trades, Larry? Now, my trading accuracy is pretty high, but that doesn't mean much. There are a lot of good systems who are only right 45% of the time. They're wrong almost 60% of the time, and they make money. So accuracy is not the be-all, end-all in this game of trading. You can have a lot of small losses and 3 or 4 big wins, and that's where the payoff comes. So accuracy, we'll talk about that as we look at some strategies, but especially when next week when we look at strategies, we'll look at the accuracy. My accuracy runs probably 60, 70%. That's great, but there's a downside to that. You'll never get high accuracy and large risk-reward ratios. It's really tough to get both of them. So you gotta be a little careful of what you're looking at, but accuracy is one of those things that doesn't mean a whole lot to me. There's an interesting question. Are candles? I don't use candles. I don't think candles add any value at all to my ability to look at the markets. Now, that doesn't mean they don't. It just means that I haven't found out how to do it. So you have to figure that out yourself. What's the best time for percent R in the E-minis? Larry, thanks. Hey, for the E-minis, I like daily bar frames. If you're going to be a day trader, then we'll want to default to tick charts, not time frames, but tick charts. Makes a big difference. Also, the things I'm talking about are just things that I found that work for me. There's some things I don't understand. Bob Proctor's a great guy, been a friend for many years. I don't get Elliott. I don't understand it. It's too complex for me. It's not how my mind works. If we go out for dinner tonight, I might have steak and you might have lobster. And we're all different. So you have to find what your mind next, oh, I got this. Then you can really understand it. And what you understand, you can, of course, become a better trader at. There's another thing I use a lot, gap ups. This is a really interesting data here. The E-minis gapped up 1,300 times. You just bought the gap on the opening. You made $195,000. But with you buying the opening exit on the close, in other words, you try to do this in the same day, you actually lose money. If you hold on to it for a couple of days, there's a lot of money that could be made. But if you're trying to get out in the same day, you actually lose money. Take the trade on just Thursday and Friday. There are 555 trades, and you make $320 a trade. That's a pretty good amount of money, which is all you're doing. If the market gaps up on Thursday or Friday, You're going to be a buyer, you're going to get out market on close, you made some money. You got to draw down $25,000, but we see a couple of things now coming together here that you can research yourself or look at. And that's, first of all, a market formation, a gap up here, and a trading day of the week. I have found something I stumbled on in the 1970s. Art Merrill first wrote about this in the 1960s, that some days of the week have a greater propensity to rally or decline than others in virtually every market, whether it's bonds or gold or crude oil or the E-minis or the dollar index. So that's one thing we want to take into consideration. So a couple of questions. What's the best time frame for ETF and bonds? What, again, that depends on yours, what works for you. I like day frame. I used to be a day trader, but yeah, a tough way to make money. Most day traders lose money, all their money. So I like daytime frame charts for the bond market. There's an outside day in the S&P today, which we'll get to that in a moment. Just bear with me a second, okay? The gaps, the only gap that is effective now, the gaps I'm talking about here are gaps where we gap from the daytime close and we open 15, 20 minutes later. There are gaps there, and those gaps, well, I'll show you some more information in a moment on that, okay? So let's go to that next. The E-mini gapped up 1,300 times. In other words, that's using the gap from the market just closed and it opens again in a matter of moments, okay? 516 times that gap was closed. 800 times the gap was not closed. In other words, 60% of the time, the gap is not closed. So there could be money made waiting for that gap, but more importantly, 60% of the time, if we do gap up in the E-minis, we continue moving to the upside. So that gives us a tell, an idea of what may happen the rest of the day. Our definition of gap is simply that the opening price of the next trading session is greater than the closing price of the session that just traded. So I hope that answers that question for you. Gaps have meaning. Gaps can mean a lot. 516 times the gap was closed. Now, if we buy the next day and exit market on close, in other words, the market has a gap, and the gap, it opens, say we close at 60, we open at 70, and that gap was closed that day. We're going to buy on the close of that day. You wouldn't know until the end. Well, in the S&Ps, that's $160,000, $310 a trade. On those 800 times, remember when the market gapped up and we didn't fill the gap, had you bought on the close of that day, you make $9,000, you only make $10 a trade, and you have a bigger drawdown. There are two critical numbers to me in looking at a system. One is the average profit per trade. If the average profit is $310 per trade, hey, that's great. You can get in, you can get out, you can pay commission, you can have slippage, and maybe have some money left over for you and mama. But if the average profit is $10 a trade, I don't care if you made $160,000. $10 a trade, by the time you have slippage and screw-ups, you're not going to make money. So this is a critical number. I see so many systems where the average profit per trade in E-minis is $100. $95. Well, that's not very realistic. It might look good for a system vendor, but not for you and I that are actually trading the system. Also, the drawdown, gee, that's a lot of money, $32,000. You made $160,000, but I like to see a drawdown that's about 10% of the amount of money that a system makes. So if a system makes $160,000, I'd like to see a $15,000 drawdown. That's a pretty good bang for my buck. So this basic idea here I have could be improved upon, and I would want to work in this area of improving the drawdown. So high average profit per trade is critical. Drawdown is critical. And another factor that is really important, imagine for a moment we have a system here that makes $160,000, and it has another system makes $160,000. They both make $310 a trade, and they both have the same drawdown. They look the same. But if we look underneath that and we see that the average length of trade in system A is 2 days, and the other system makes the same amount of money, everything else is the same, the average length of trade is, say, 6 days, that means system A is more effective. It gets in and it gets out and makes the same amount of money in less time. It is a more effective system. That's how you measure a system's effectiveness. And it also tells us we don't have as much risk because we're not exposed. Boom, we're in, we're out. We're not exposed to a sudden windfall for us or against us. I'm more worried about against us. So the amount of time it takes us to dig into the gold mine and get the gold out of there, to me, is a critical number to have. That measures the effectiveness of a system. So that's another thing we want to really look for when it comes to looking at system performance. We're talking about gaps up in the future market. Well, how about gaps to the downside? If we gap down, how about if we buy in the open? Again, we're looking at the S&P E-minis. There are 528 trades where we gap down, but we buy on Tuesdays and Thursdays only. We make $172,000. Is that a simple enough system for you? Altogether, we've gapped down 1,200 times, but your average profit per trade is $220, and you're down at $1,050,000. So if we limit that to just specific days, Tuesdays and Thursdays, you do great. You cut down the number of trades, you make $172,000. The average profit is $332. Again, a real trailhead for developing systems and stuff on your own, because we see a high average profit per trade. Drawdown's not too bad, and we're able to eliminate a whole lot of trades. How do you get data for the best days? I'm going to show that in a moment, Richard, so just bear with me and we'll take a look at that. I started all this going back to 2002 and the results I'm showing today, because of course that's when we went into electronic markets. Gaps not filled by the next day, exit MOC. We don't know if the gap is filled or not until the end of the day, right? So if the market gaps down, the gap isn't filled, we're going to buy in the opening. Well, that makes $81 a trade, not so hot. Gap down, we're filled the next day, makes $176,000, but we only make $103 a trade. And I'm only using one contract on all of this, David, when we're looking at the data. It's just buying on a one contract basis. So we see that buying a gap down the day after a gap down, whether we fill the gap or not, obviously we've got to do a lot to work on this example, isn't it? In fact, this may be a critical point for you. I'd like to take you back in time to about 85, 86. The S&Ps had just started trading. We had the large contract back then. Had a system that still works, and it was just made the money on the long side. And one of the fellows in him said, "Oh, Larry, this isn't any good. It's only biased to the long side." I said, "Yep." He said, "Well, what if a big bear market comes along?" I said, "Well, you might lose some money. You might still make money." But I have found in all of the systems that I've worked with, it doesn't matter if it's treasury bonds or stocks or natural gas or beans or corn or the dollar index, the Australian dollar. It's easier to create systems that work from the long side. That it's easier to find systems that make money by buying. You can get some big winning trades in systems that sell short when you get those big debacles in the market. But in terms of a knock them out and bread and butter approach, grinded out profits in the markets, the long sides of most all of these markets seem to be much easier to trade from for short-term traders. I'm not talking about trend traders here. I'm talking about moves that last 2, 3, 4, 5 days, something like that. So I think it's okay to have a bias to the long side. I'll talk about stops as we in a moment here. No S&P futures is a backwardation with the S&P index. I mean, backwardation, Alessandro, really doesn't apply much to the S&Ps. It applies much more to physical, natural resource commodities than it does the synthetic commodities such as currencies and bonds or the S&P. Well, here's a real simple pattern for you. You can take this one home. Makes $107,000, draw down $16,000. That's good. Average profit per trade, $720. That's great on 150 trades. Like the rules for it? Here it is. Buy all days but Monday. If my percent R, which I developed in 1965 or 6, it's been around for a long time, is less than 10, and the market is congested. Well, the only thing we need to define here is congested. So I would say that if today's range is in the range of the last 3 or 4 days, 5 days, the market congested. Imagine if today's range is below the range 10 days ago, well, we're in a free-falling market, right? So we can define congestion by saying if today's range is within the range of a certain time period ago, we want to be a buyer. I'm using the percent R, you can actually, this will make money whether you use a 5-day percent R or a 10-day percent R. The time period of the percent R is not all that significant. Why do I think day of the week matters? I think that there's an emotional action that takes place that going way back, way back. Come with me as we study the market in 1910, 1920, 1940, 1950. And you see markets invariably, stock market, bottoms on Tuesdays. I have an idea why, but the why in a way doesn't matter. It just does. We've seen this so often. I have seen this for 50-some years of my life of trading. Probably because over the weekend, people read newspapers, they get all bearish, they dump their stocks on Monday. That market continues going down on Monday, or comes down Tuesday on the opening, and then buyers come in and reverse the market to the backside. That's probably one reason why Tuesdays would rally more, as one example. So there's one. Let me see if we have any other questions that come in. Percent R is a negative value indicator. What do you mean? Well, percent R is a positive value indicator. You're not using my percent R, I guess. If you'd like to read more about that, you can go to our website, allfreeireallytrade.com, and we have a special report on percent R there that might help you. Now, I am using a stop on this trade, a stop of about, you can vary your stop in the S&Ps, E-minis of about maybe $1,800, whatever you're comfortable with, somewhere in that area. Does your backtesting results change materially as you change the backtesting period? No, it doesn't. As long as you start from when we went into electronic markets, things stay pretty much the same. And you will not be getting PDF slides, but TradeStation will be posting this, so you can go back and look at this, is my understanding. Well, how about holidays? Hey, happy holidays. Here's a trade for in the gold market. What kind of indicators and patterns do you use for swing trading? Well, indicators I don't think are the best way to do swing trading. I just showed you a great example right here, and I'm going to show you another one of things you can use for short-term trading in the market, holidays. If you buy gold one day before all holidays in the gold market, make $46,000, $650 a trade with a $5,000 drawdown, and 70% of the trades were winners. And again, we'll use a protective stop of about $1,500. You can vary that yourself. Your systems trade real time similar to your back testing? Yes, I trade real systems in TradeStation with my money. And I think I may be the only one that actually does that puts money on the systems that we trade automatically, mechanically in TradeStation. That's what we'll be telling you more about next week. You never finish your thought on congestion, how to define it. Well, I thought I did, but let's try that again, Richard. Congestion would be that today's high is greater than the lowest low of the last 3 or 4 or 5 days. If today's high is greater than the lows, we know we're in some form of congestion. Does that help it? Why does gold do that? Why does it rally before the holiday? You know, again, I can come up with a reason that will probably sound really logical to you. Say, yeah, that's right. But it's something I probably made up or may be wrong. All I know is it doesn't. So I'm much more concerned about that I see this happening often enough over a long time period. I'm going to try to take advantage of it. This is buying at the opening of the electronic session. Are there some intraday reliable price patterns? Yes, there are. John, we've done that on several of the TradeStation presentations. I've given reliable price patterns as well. We talked about the Tommy gun pattern and the turtle trap pattern, and a few others that we've already done. So you can look at that. Yes, you only have 5 patterns for a year, so you don't get a lot. It doesn't trade often, does it? It's only traded to 65 times. So it doesn't trade a lot. So you have to have more than one arrow in your quiver, don't you? Okay, so what can we look for? Well, we can look for short-term patterns like gaps, like large and small ranges, like percent R levels, like reversal days, like holidays, trading days of the month. I'm going to talk about in a moment. And some months are better than other months. Typically, September's been a bad month for the stock market. October, the couple first weeks of the market of October has been a bad week, bad time, but then the last couple of weeks of October and November have been strong for stock market. So there are seasonal biases, and those can be very helpful. We have seasonal indicators on my work at TradeStation, so you can see what those are for yourself. I was the first person to ever write about seasonals back in the 1970s, and they're not perfect. We've done one presentation here on how to make them a heck of a lot better in TradeStation, and so you might want to revisit that if you haven't seen it yet. When did I test the gold trades, Larry? Carlos, I tested the gold trades. That was 2 weeks ago I tested them. Oh, I know. You mean what time period did I test, right? I tested gold from 2002 up to date, or 2003, whatever. I forget the exact year, but that basic time. Trading day of the month. We're gonna look at that in just a moment. We're getting to that. Here it is. Trading day of the month. Beans. What do I mean by trading day of the month? Well, a month can have up to 23 trading days in it. If there's a holiday or the markets are closed for a storm or a riot or whatever, we won't have a certain number of trading days, but we can have up to 23 trading days in a month. Of course, a month like February is going to have 23 trading days. But I look at that as a potential. So in beans, in the month of August, we have a really cool little searcher that will go out and say, okay, in August, there have been 23 trading days in the month of August, and that's only occurred 5 times in the last 5 years. In the last 11 years, we've only been 5 times we've had 23 trading days. Notice all trades is over here. So in the last 11 years, we've had 4 trading days. So we have a 4th trading day in soybeans. So what can we say about soybeans? Trading day 1, 2, 3, 4. If it's trading day 1 and you buy tomorrow, what happens? And we see, gee, the first of the month in beans is kind of negative, but in the middle of the month, right around trading day 14, 15, notice what happened in trading day 13. That was a couple of days ago in soybeans, and what they do, they rallied. So we can do a particular test in TradeStation. If it's this month, this market, what trading day of the month is the best trading day of the month to be a buyer or a seller? I just did the test for the S&P E-minis. We report this on my Larry television show that we do once a week. And Larry TV, we pointed out that trading day 14, 15 in the S&Ps is when we get big rallies, buying the next day. Well, today, this big up range day, outside bar day is trading day 16. Bingo. Right where we would expect this short-term trading day of the month strength to come into the marketplace. So this is one of my original concepts, is to look for strengths and weaknesses. And I know this in advance. I'll get to your questions in a moment here. I just kind of get carried away with this idea. I know at the first of the month I can run this and go, oh, hey, as a short-term, say, day trader, I want to really be interested in buying soybeans around the 20th trading day of the month because, look, I make $2,400 and 80% of the trades were profitable. Trading day 14, all of them were profitable. Oh, I don't want to be a buyer in trading day 9, 10 because it lost money and they're only 50% profitable. So I can get an advance indication. See, the problem I think most very short-term traders and especially day traders have, they're clueless. They don't know if the market's going up or down. They don't have a reason. It's like, oh, there's something on my chart. Well, I don't think charts move markets. I don't think technical indicators move markets. I think conditions move markets. So I want to get to these conditions, and then I can use the indicators, and they make a lot more sense, and I think they can be more profitable. So this is one of the conditions, trading days of the months. I know when I need to focus in on the long side or the short side of a market. Okay, a couple questions here. If our indicators conflict with some fundamental news, which to follow? You know, I don't follow fundamental news. I don't read news. I don't listen to news. I just trade what's in front of me. So the answer to that. So we then narrow it down to trading day of the month. Why? Yeah, if you're say a cattle trader, you like to trade cattle, why not find when your strong trading day for August, September, October, November are, and be alert that your buy signals at that time of the month are going to work better than when a trading day, you have a cluster of weak trading days of the month. Wouldn't that make sense? It does to me. Which conditions are critical in case of trading U.S. stocks? Also, we can do this trading day of the month concept on U.S. stocks, so you can find the best trading day of the month for Google or IBM or General Motors, General Electric. How can I find this info? We have this in a TradeStation pack. That's one you can subscribe to, and we're announcing it in a couple of days if it's not already there. So it's one of our little tools you can subscribe to. Do you use like the 1, 2, 3 pattern? The 1, 2, 3 pattern developed by Ken Roberts or popularized by Ken Roberts, a good pattern, but it only talks about charts. And like I said, I don't think charts move markets. I think conditions do. So I would want to know the condition of the market before I took a 1, 2, 3 pattern signal. Do you avoid trading in September or go 100% cash in September? No, John, I will want to take sell signals will be more effective in September. So I play the long side. I need a lot more information to take a buy signal in stocks in September. And if I get sell signals, well, I've got a strong bias there, huh? Larry, your Tommy gun and other price patterns presentation are not in TradeStation. Can you tell us where they are? I thought they were in TradeStation. I guess they're not in TradeStation. Well, they're in, guys, I'm 71 years old. I've written 7, 8, 9 books in the market. I don't remember where all this stuff is anymore. That's why we do these webinars. So we'll eke out some of this stuff from an old man. They're probably stuff that we've done for my subscribers over the year. I apologize for that. And in a futures market outlook presentation, here's a lead somebody just gave. Okay. Any news on Ninja Traders for indicators? Hey, we're on TradeStation. We're talking about TradeStation. So here's the lesson is search for biases. Yes, the biases. It can be more than trading day of the month. It could be the commitment of traders along. It could be have an outside day with a down close, inside day with an up close. You need to search for a bias as a short-term trading. That's what you want to look for, okay? Oh, let's see what else we have here. Putting it all together. There's a place for people like me, and I've been told often where that is, but I'll try to explain a little bit. Supposed gurus like myself, and I certainly am not a guru, but people think we're hotshots because we've written those books. Well, as I see it, we can walk beside you, but I can't do it for you. I can shed light, I can point in a direction, but you've got to internalize this stuff so you have ownership. That's the confidence that begets success. Remember when I started talking at the beginning, I said the reason people have systems is they lack confidence. Well, if you have not done the research, you have not poured through charts as we used to in the old days, looked at charts on computers, run numbers through your computer, you don't really have the confidence to trade. So you naturally latch out to a guru who supposedly has done all this stuff, and a lot of them really haven't. And some of them have. So you still have to figure out which guru is really the one you can be confident with. But I think being a good trader is all about being confident. And the more of this you internalize by doing it yourself, by riding that bicycle and falling down and getting back up, the better of a trader you're going to be. That's what I think. Let's see. So you need to get confidence. A carpenter needs tools and good ones. He pays for them and he has the right tool for the right job. So don't grasp for indicators. Just because there's a jillion indicators out there, the thing I was so blessed with when I started in the markets, I think there were only 3 or 4 indicators. That was it. So we focused on 3 or 4 indicators and I came up with a couple. And now, how many indicators are there? Probably 1 per trader or 1 per computer in the world. Everybody's got an indicator. There's plethora of stuff and we get stuck in the mess of it. Like, I've got this indicator, that indicator, and you can't take any out. You don't know what anything is saying. At least in the old days, we had to do it by hand. But the joy was we just had a couple of indicators. We learned them real well, and we plotted them every day by hand. So we got a tactile feel for them. Now there's so many indicators. I'd say toss out my indicators, or anybody else's indicators. Try to advertise 1 or 2 indicators, whatever you like. And I think you'll be more successful as a trader. You've got to get the right tool for the right job. So let me explain that. If you're a trader who wants to be a day trader and you're going to trade, say, 5-minute bars or what, about 125-minute bars in a day session, well, you better be using an oscillator or moving average value of maybe 6, 7, 8 bars in it. If you're a longer term trader, you think there's a cycle in gold of 13 months, then you're going to want to use a much longer term time frame of your indicators. So the indicators, it's just an indicator. It's a time frame that matters. If you're trading with a 10-day indicator as a short-term swing trader, that indicator is really telling you about 5 days market action, because in a cycle we have 5 up and 5 down, right? And most of these oscillators, et cetera, are really cycle indicators. So if you want to capture a 35-day move and you're using a 10-day oscillator, ain't going to happen very often. If you're trying to capture 35-day moves, you need to go out to a 70-day oscillator and use a 17-day oscillator. So you have to match the measurement of the data in your indicator with what you're trying to accomplish in the market. Does that make sense to you? And see how that handles? Gee, a lot of questions have come in. What's your view on gold and silver right now? I've been very bullish on gold for some time. In our forecast we wrote in last December, we said gold's going to rally in August. It's going to continue rallying. This market's in an up move. Yeah, search for biases. They're there. Let's see. Could you sum up in a few words the basic differences between your 249 course and the more expensive courses? Well, yeah, sure. 249 course is cheap. The $10,000 course is expensive. It also includes 10 weeks of personal mentoring with me. The 249 course is a great way for people to get involved in the market, find out if this is even for them. That's all a lot of people need, and they're happy with that. And they go their way and they do well. And some people want to get an advanced degree. And for that, we have more personal work with Larry and webinars and all that kind of stuff. Just, like anything, you get more. The more you pay, the more you get. Can you say what steps for a beginner? For example, first read psychology. Well, for a beginner, first try to find your risk tolerance level. Read as many books as you can. Take the one that makes the most sense to you, that you understand it the most, and then paper trade. And you can do that with TradeStation. And then when you feel you're ready, then start to open up the doors and start trading very, very slowly. How about your downside oil chart? I haven't even looked at oil today. I don't have any idea. I'm sorry. What's the cycle for the S&P unit in %? Swing trading with the cycle for the long-term cycle for stocks has been about 13 weeks and 26 weeks. How many years of trading you're in confidence? Well, I'm still not confident. I still have shaky moments. And that's good. You don't want to become too confident. My son, Dr. Jason Williams, a psychiatrist trained at Johns Hopkins, did a book, somebody just mentioned a moment ago there, where he interviewed highly successful traders, guys that have made billions of dollars trading, and traders like myself that have done well but don't manage money, so we're private traders. And one of the things he noted that surprised us in his personality profiles is none of us were overly confident. And we were confident, firm, but nobody was like rip-roaring, ah, da, da. And we think that's because if you're overly confident, you don't use stops, you don't listen to the markets, you get beat up, and then you're out of the business. So there's a fine balance between being gung-ho confident and just being, you feel stable about yourself. You feel good about what you're doing, but overconfidence can cause, obviously, an equal problem. Could you please the title of Jason's book, Mental Edge in Trading by Dr. Jason Williams? Yeah, I am. Well, I'll be 71 in October, so we're almost there, right? You use tick trades and long-term. I don't do much intraday trading. I don't use candles. I just candles. I started with open, high, low, close bar chart. That's what I like. Candles just add more stuff to the soup, don't they? Now you got dojis and wojis and wings and wedges and morning glories and purple triple dragging hangings, ghost image. I don't know. Just too confusing. I like it simple. Besides, when I'm in Japan, I asked my old friends there about candlesticks, and they say, I can't use the words they use to describe them here. They basically, well, we use them. Sometimes they're good, and sometimes they don't. And they use open, high, low, close charts in Japan as well. It's been a great marketing ploy. Millions of dollars have been made off traders selling all this stuff about candlesticks. I just keep it simple with what I learned to begin with. Okay. Actually, it's October 6, 1942. Okay, so you need a strategy. Don't grasp for this stuff, but you need a strategy, a methodology. It could be a mechanical system, but it can't be guesses. You need to have a basic idea of, I think the market, so there comes helicopters overhead. I think the black ones, no, the fire ones. I think you need to have a basic idea, concept of how you think the markets work. Maybe it is Elliott. Maybe it is Fibonacci. Maybe it is whatever. But you need to have that pretty figured out. This is how I think they work, and I'm going to trade on that strategy. You need to have at least that as a discretionary trader, and your system should also be based on some idea. Years ago, I developed a system for trading coffee. I had over 1,000 trades in the system, and it didn't have a successful trade for, I think, a year after that. Just lost money hand over fist because it was just based on running a bunch of numbers. You need to understand, well, When are the commercials long? What's the season in coffee? What's the open interest? You have to all this stuff to get a good system. There needs to be a rationale of why the system works, and the system vendor should be able to tell you explicitly why the system should work. And then, yeah, the nice thing about T2M, I know months in advance when I should expect a rally. There's going to be a rally in stocks the last couple, 3 trading days of November and the first trading day of December. Okay, I'm not psychic. That's how the markets have acted the last 50 years. It'll probably act that way this year. May not. That's why when I get there, then I want to look at my charts and see how the market moves, where my entries are, and where my stops are. Will you show us some real-time trading today? I'm locked into these PowerPoints. This is all that we talk about today is what's in the PowerPoints. Next week, I will show real trades from my real account and the real systems that I trade at TradeStation. Oh, let's see. How come bonds are still down in August? Well, there's been more sellers than buyers. Bonds should rally in here. They haven't. So all we need to do is wait for a trend change. Just because there's a seasonal bias to rally here, and I expect that they would or will, but we haven't had a trend change. So we still need a trend change in the market. I mean, it's pretty simple. Think about it. You get a bullish condition in the market. Maybe it's just a seasonal tendency to rally, or commercials, or there's a full moon over Jupiter, whatever. You think there's a condition the market should rally. Bully for you. Until it does, we really don't want to take action. That's why I like condition trend change. It's a setup and trend change. Whether you're a short-term day trader or a long-term trader, find the condition. Maybe it's market's overbought, market's oversold. That's a condition. But then you have to wait for the market. Oh, now I'm responding to that condition. You see that? It isn't just enough to have a condition. You have to have a condition and the market confirm that condition. Was a short covering rally in the S&P Mini? I don't have a clue. I haven't looked at the markets, but I'll tell you this. It's real easy to answer your question for you. Go look at the number of stocks, net stocks advancing over declining. I did look earlier in the day, and we had pretty good market breadth. So look at what's happened. This market fell apart up here when we forecast it would, by the way, as my readers of my forecast report know, that it fell apart because we had the advanced decline line, serious deterioration, new highs in stock prices, not an advanced decline line. So continue to watch this advanced decline line here. That's market breadth. That's what's going to show you the most of what's happening. Was it a false popcorn rally? If we didn't have 1,000 stocks up today, yeah, it was a false popcorn rally. Can you still get a copy of your advice? No. We do these forecast reports, and a lot of work on my part. We put them out for sale, and then we stop selling them, and then I go back to trading. So I really am not like a marketer guy out there selling stuff all the time. I want time to trade. I guess if you emailed me, would send you something about it, but go to ireallytrade.com. We'll try to get something out to you. But by and large, we try to get back to the business of trading. Which indicators, from your point of view, are more in condition? Well, they would be seasonals, would be a condition. Advisory sentiment, how many newsletters are bullish or bearish, is a condition. The commitment to trader report. So there we want to look at the commercials. That's a condition. Large trader, definitely a condition. Small traders, absolutely definitely a condition. Also, valuation. Is corn overvalued or undervalued? That's a condition. None of your timing tools. The conditional setups. I like to see a market get set up, like corn is set up, should rally in here. But we still need a trend change. We need a timing mechanism, which we haven't had. What's your favorite indicator for recognizing a trend change on daily charts? Moving average, volatility stop indicator. I've done some stuff with volatility stop indicators that I think is the best, but really the simplest is a trend line. A market making trend line penetration or market making a higher short-term low is the most immediate, it will be the earliest indication of trend change. So that's it for you. Yeah, it's a great question here. It's amazing. Every successful as a trader has a different approach. For example, your unpopular opinion about candlestick. I just say I don't use them. It doesn't mean they're not any good. It doesn't fit me. I had 20 years under my belt of open high low closes before candlesticks came in. I'd have tested them. I don't think there's much there. I mean, I don't think this speciously. I've done a lot of tests. I did an article for it in Futures Magazine years ago. I don't think any single candlestick pattern can lead to a profitable trade. It's part of a condition, perhaps. My good buddy Greg Morris has other ways he's developed candlesticks into what works for him. But I'm not negating anything. I'm just saying this is what I found works for Larry Williams, and you have to find what works for you. It's just like I said, we're going to go out for dinner night. I'm going to order steak. You're going to order lobster or fish or salmon or pasta, or you're a vegetarian, whatever. You have to internalize what you grasp. I got it. I see how this works. Gene, hello to you. Long time, huh? What do you think about sugar? What is your setup? I haven't looked at sugar. I'm in Montana fishing, guys. This is August. It's the best fishing in Montana. I haven't looked at the markets a whole lot, by the way. Are you bullish on the dollar index? Again, I don't know. I don't do a newsletter. I do a recap of the market, not a recap, but on Sunday I do Larry TV, where I talk about what I think is going to happen in the market, not what you want me to talk about, what markets I want to talk about, because I think they have moves, and I'll comment on those specific markets. I want to be a buyer here or seller here for the coming week. So I don't, you guys are used to newsletters that write about everything. I'm a trader. I want to focus on what's ready to go now. That's a little bit of difference there, I guess. How bad do costs of rollover impact a trader who's trying to bet and hold futures as a long-term trading time frame? Not much. The cost of a rollover is half of a commission. That's all that it is. So it's not a lot of money for rollover. So here's your strategy. Let's put this all together. Your strategy must fit you. You must be able to take losses. If you can't say I'm wrong to your wife or your significant other or even to your kids, when you are wrong, you should never be a commodity trader, because you've got to admit defeat and get out of there. And that's the hardest thing to learn. Say, I'm wrong. You just have to learn to do that if you're going to be a good trader. Can't pack up your computer, shut down TradeStation. You've got to learn to take losses. Quit dreaming. This is very hard to do. See all this stuff about day trading, and you make a fortune day trading. Well, the dream of day trading really becomes a nightmare for traders. This is hard work. You never make money with easy work. It's always difficult to make money. I don't care how you make your money. So you need to stop thinking this is going to be easy. This is going to be blood, sweat, and tears. It still is for me. I know some of the very best traders in the entire world, the best that's ever walked on this planet. And it's still difficult. He still has ups and downs and pressures, and this is his business. And you better accept that, which means it takes dedication and focus each day. And it takes discipline. But discipline comes from devotion. If you're not devoted to this, you're not going to be able to have discipline. See a question that came in here, so let me go to a couple of questions. We'll come back to this PowerPoint. What's your thought on these opening range for ES Mini 15-minute determined trend day? Chris, that's a strategy that used to work. I haven't looked at it for a long time because I'm not much of a day trader anymore. Hey, I'm an old man, right? But it's a number crunching game. Sometimes it's successful, sometimes it isn't. It's going to be more successful when, say, you have one of my blast off indicators there, or you have, say, a Tuesday or a trading day of the month concept, right? It makes sense to combine these things together. I'm confused. You trade here and there, at least on this week. How do you do your analysis on conditions for all different markets? Well, I have my TradeStation set up and I have my fundamental chart. Well, I have my indicators, my setup tools, and I look at my setup tools and say, hey, this market's ready to rally. I don't know exactly when, but then I go to the daily charts and find out the when and the timing aspect of it. I hope that answers that question for you, Patricia. If not, let me know. This presentation is supposed to be an hour, I think, so we're just about have to wrap this up, guys. Do your tools and early books and stocks and commodities still work? Yes, still works. I'm not doing big fish trading. I'm not doing much public at all anymore. The exits in the gold trade is the exit on the first profitable opening or a dollar stop loss. How many different markets do I actually trade at a time? 3 or 4. I never want to be in 5 or 6 positions. 3 or 4 markets. I'll watch most of the actively big markets, but I'm only trade 3 or 4 at a time. No more new books. I have arthritis in my hands. I don't like to type much. I never did learn to type. What's the difference between devotion and discipline? Well, discipline is you're going to do what it takes to be done. But to be really disciplined, I think you have to be devoted to what you're doing. That's the foundation that discipline comes from. Excellence and money management are critical to your success. We don't want to know, even if we saw it here today, how do I get in? What's the pattern? What's the indicator? How many questions were about how do I get out of this thing? Well, getting out is really critical. You better spend a lot of time on your exits. That's really, really important. And how you manage your money. Here's a question I get quite a bit. Will you have more chance if you trade more than one setup market? It would depend if they're different markets. If you're trading gold and silver, you're going to get the same results. If you're trading gold and potato chips, whatever, then you're spreading your risk a little bit. Is it better to hit singles and take small profits? Gordon, that depends on, does that work for your personality? Some traders just like big moves, they'll suffer some consequences to get those. Depends on how much risk tolerance, how much pain you can sit through, how soon you want to be rewarded. That's why people like to day trade. They think you get all their money in one day. They like that idea. May or may not happen. How many millions have you bank trading over the year? Well, my wives have banked a lot of millions, and I've had a lot of fun and a great career. But I am the only one that I know of who can stand in front of you public and say, I have made millions of dollars trading. And I've demonstrated that whether it's trading championships or in personal trading. I've done that. Not once, not twice, not 3 times, but repeatedly. And then I take time off and go do fun things or get bored or whatever. But I have actually done that. I've done that. And there are a lot of other people that made millions trading. I'm not saying I'm the only one. But of those of us that are public, I think I'm probably the only one to tell you that. Gosh, we've gone a little bit over our time factor. I don't use Kelly factor in my money management. I use Kelly's way too risky for me. So we are at the end. Hey, I'm not running marathons, but I did run. I'm back to running again. Thank you. Word on comparative strength. Um, hey, thanks, Michael. Comparative strength. If I'm going to be a buyer in the grain market, I want to see what's been stronger, soybeans or soybean meal, and I want to buy the market. It's been the strongest, not the weakest. That's the bottom line to comparative strength. We're going to wrap it up here. I hope I've given you a little insight into the markets, a little insight how I think maybe that will help you in some fashion. And again, I'm certainly not the be-all, end-all. I'm just a trader going through life trying to make a buck here and every now and then in a trade. And I tried to share with you the things, the real things I've learned from the last 50 years of doing this. And there's so many great people here. I see so many names. I want to thank you and look forward to seeing you guys and gals. We will be in Los Angeles. We'll announce that to our people this coming week. Not this coming week, but in a couple of weeks, the first part of September. Maybe we'll get together and see people if we can put something together. But I just want to thank everybody for being here today and wish you good luck, good trading. This has been a great life for me. I hope it will be for you. Just follow some simple rules. Keep it simple. Use money management, and I hope you'll experience the markets as I've experienced the markets. Good luck to you. Good trading to you.
Thank you very much, Larry. Great series. You can catch Larry Williams in Futures Market Outlook at least once a month. And again, here is the link for Larry's event coming up next week. And all of the events are archived on the TradeStation website. So thank you, everybody, for joining us. And we hope to see you at another event soon. Again, thank you, Larry. Thanks, everybody. Have a good evening.